Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Tuesday, May 5th, 2026. And we're seeing some interesting market dynamics as gold pulls back from recent highs, while corporate earnings continue to surprise. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story right now is the shift in safe haven positioning following geopolitical developments. Gold opened at its lowest level in over a month after attacks near the Strait of Hormuz, but what's particularly notable is how quickly markets are reassessing risk. We saw Maersk report that one of their ships passed through the strait under US military protection, which signals that trade routes are being secured despite tensions. Oil prices actually slipped as the Middle East truce appears to be holding, which is counterintuitive to what many traders expected. On the corporate side, we're seeing strong earnings performance that's helping to anchor equity markets. Pfizer topped Wall Street estimates while reaffirming their outlook, showing their newer products are gaining traction. Palantir delivered an exceptional report with 85% revenue growth, which is their fastest expansion since their 2020 market debut. Marathon Petroleum beat estimates on refining strength, and PayPal rallied after their first earnings report under new leadership. The M&A activity is also picking up significantly, with Amex GBT agreeing to a $6.3 billion take-private deal with Long Lake and Vodafone buying out the UK's biggest operator for $5.8 billion. What's particularly interesting is the crypto exchange Bullish striking a $4.2 billion deal for a transfer agent in what they're calling a tokenization push, which shows how traditional finance infrastructure is being rebuilt for digital assets.
That's quite a mix of developments. The geopolitical situation seems to be stabilizing faster than many anticipated. What does this mean for traders looking at the week ahead?
For traders, the key insight here is that markets are showing resilience and selectivity. The fact that oil prices are declining despite Middle East tensions tells us that supply concerns are easing and the truce is being taken seriously. This creates a more favourable environment for risk assets, but with an important caveat. We're seeing companies threaten price rises according to Financial Times reporting, which means consumers are facing more pain ahead. This creates a bifurcated market where strong performers with pricing power will continue to outperform, while companies exposed to consumer discretionary spending could struggle. The earnings theme is particularly important because we're seeing real operational strength, not just financial engineering. Palantir's 85% growth isn't coming from cost cuts, it's coming from genuine demand for their AI and data analytics platforms. PayPal's rally under new leadership shows investors are willing to reward strategic pivots when they're executed well. For positioning, I'd be looking at companies with strong cash flow generation and pricing power, while being cautious on consumer-facing names that might struggle with the price increases we're hearing about.
Let's look at the technical picture for the major indices. How are the charts setting up?
The technical setup is constructive across the board, though we need to watch key levels carefully. The S&P 100 is showing steady strength, holding above its 50-day moving average with good volume support. We're seeing breadth improve, which means the rally isn't just concentrated in a few mega-cap names. The index is testing resistance around recent highs, and if we can break through with the support of strong earnings, we could see a measured move higher. The Nasdaq is particularly interesting because it's benefiting from the AI and technology earnings strength we're seeing from companies like Palantir. The index has reclaimed its short-term downtrend line and is building a base for what could be the next leg up. Volume patterns suggest institutional accumulation rather than retail speculation, which is a healthier foundation. The Dow Jones Industrial Average is lagging slightly, which makes sense given its exposure to more traditional economy sectors, but it's holding support levels well. The key for the Dow is whether the oil price decline translates into better margins for industrial companies or whether the consumer weakness starts to bite. Overall, the technical picture supports a continuation of the current trend as long as we don't see a breakdown in the geopolitical situation or a major disappointment in upcoming economic data.
That selectivity is going to be key for navigating these markets. Steve, let's get into the economic numbers. What's the picture looking like from a data perspective?
Thanks, Robert. We're in an interesting period where the economic data is painting a mixed but generally stable picture. Indonesian growth surged to 5.6% despite what they're calling an Iran energy crisis, which shows that some economies are managing to maintain momentum even with external pressures. This is significant because it suggests global growth isn't as fragile as some feared during the peak of geopolitical tensions. Looking at the US situation, we have major health insurers showing signs of recovery, but as CNBC reported, a key test is still looming. This matters because healthcare spending is a significant component of both consumer expenditure and corporate costs, so any stress in that system ripples through the broader economy. The defense sector is showing strong demand, with Leidos raising their 2026 forecast, which tells us that government spending remains robust in certain areas. What I'm watching closely is the interplay between the corporate price increase threats that the Financial Times highlighted and actual consumer spending power. We've seen this dynamic before, where companies signal pricing power, but then demand destruction forces them to pull back. The fact that we're seeing strong earnings from companies like Pfizer and Marathon Petroleum suggests that, at least in some sectors, demand is holding up well enough to absorb higher prices. The employment picture remains crucial, and while we don't have fresh jobs data this week, the corporate earnings guidance we're seeing suggests companies are still hiring in growth areas like AI and technology while being more cautious in consumer-facing sectors.
The divergence between sectors seems to be the story. Are there any upcoming data points that could shift this narrative?
Absolutely. While we don't have major Tier 1 releases like NFP or CPI this particular week, the earnings season is effectively serving as our real-time economic indicator. Every earnings call is giving us insights into pricing power, demand trends, and forward guidance. That's arguably more actionable than lagging government statistics. The M&A activity we're seeing, like the Vodafone deal and the MXGBT take private, suggests that corporate executives and private equity see value in current market conditions and are confident enough to deploy significant capital. That's a leading indicator of economic confidence. The oil market dynamics are also functioning as an economic signal right now. The fact that Brent crude slipped after closing at multi-year highs tells us that traders believe the supply situation is manageable and demand concerns might be emerging. Lower energy costs, if sustained, act like a tax cut for consumers and businesses, which could help offset some of the price increases we're hearing about in other areas. I'm also paying attention to the bankruptcy trends, with the Wall Street Journal noting that U.S. bankruptcy fights are heading to London, which suggests companies are looking for more favorable restructuring environments. That's typically a sign that financial stress exists in certain pockets of the economy, even if the headline numbers look stable.
That's helpful context. Lizzie, let's turn to crypto markets. Bitcoin reclaimed the $80,000 level this week. What are you seeing in terms of trends for the major cryptocurrencies?
The crypto market is showing significant institutional strength right now, and Bitcoin is leading that charge. BTC successfully reclaimed $80,000 in what analysts are calling a post-ceasefire recovery, and we saw $532 million in fresh ETF inflows, which is substantial. What's particularly bullish is that institutions are reportedly absorbing 500% of daily Bitcoin supply, creating serious buying pressure. Bitcoin briefly tested $81,000 before some volatility around Iran missile reports pushed it back to $79,000, but it stabilized and is now testing $80,000 as support rather than resistance. The technical picture shows a bull flag pattern, with traders spotting an $84,000 target, and some analysts are calling for $89,000 based on a MACD crossover signal. There's even talk of $95,000 to $96,000 if institutional demand continues at current levels. The mining sector is healthy with rising miner profits, and we're seeing corporate treasury adoption accelerate. Strive just added $33.9 million in Bitcoin, pushing them past 15,000 BTC, and GameStop's potential eBay takeover bid puts their $368 million Bitcoin stash in focus. The key level to watch is whether 80,000 can flip from resistance to support, because that would confirm the next leg up. For Ethereum, we're seeing a confirmed bull flag breakout with a clear target of $3,000. ETH holders are back in profit after the recent price recovery, and one of the largest Ethereum treasuries just purchased $238 million worth of Ether, which Tom Lee is calling the start of crypto spring. There's some legal complexity, with Aave filing emergency motions regarding frozen ETH from the Kelp exploit, but that's more of a DeFi governance issue than a fundamental Ethereum problem. Solana is showing steady performance, with a major validation coming from Western Union beginning their USDPT stablecoin rollout on the Solana network. Moscow Exchange also added SOL to their crypto indexes alongside other major cryptocurrencies, which signals growing institutional recognition. Solana maintained stability during the broader market volatility, which suggests it's maturing as infrastructure. The sentiment across all three is bullish for next week, with Bitcoin targeting 84,000 to 89,000, Ethereum aiming for 3,000, and Solana likely to follow the broader crypto market trend while benefiting from enterprise partnerships.
The institutional adoption story seems to be the key driver. How are you reading the split between institutional and retail participation right now?
The institutional versus retail dynamic is really defining this cycle. On the institutional side, we're seeing massive sustained buying through Bitcoin ETFs, with that $532 million inflow being just one day's worth of activity. Companies like Strive are building strategic Bitcoin reserves, and the fact that institutions are absorbing 500% of daily supply means they're not just buying what miners produce, they're taking coins off the market from existing holders. This creates a supply squeeze that's fundamentally bullish. The corporate treasury trend is accelerating beyond just the usual suspects, with even traditional companies exploring Bitcoin allocation. GameStop's Bitcoin holdings becoming relevant in their eBay takeover discussions shows how Bitcoin is becoming part of corporate finance conversations in ways it wasn't even a year ago. On the retail side, the participation is more measured this time around. We're not seeing the euphoric speculation that characterized previous cycles. Retail seems to be following institutional lead, rather than driving the market, which actually creates a healthier foundation. The options market activity shows desks are bidding on further price jumps, which indicates sophisticated traders are positioned for upside. And Seckle and Coinbase leading crypto stock rallies amid Clarity Act progress shows that regulatory clarity is attracting both institutional and retail capital. The risk is that retail FOMO could kick in if Bitcoin breaks through 85,000 convincingly, which could create short-term volatility, but for now the institutional bid is providing solid support. The key for traders is to recognize that this institutional buying provides a floor under prices, so any dips related to geopolitical noise like the Iran missile reports are likely to be bought. That said, risk management remains critical because Bitcoin still correlates with traditional risk assets during major uncertainty events.
Well, that gives us plenty to watch as we move through the week. The combination of solid corporate earnings, stabilizing geopolitical tensions, and strong institutional crypto demand is creating an interesting backdrop for markets. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you never miss our daily market analysis. I'm Robert, thanks to Lizzie and Steve, and we'll see you tomorrow.